Scene opens with you, the host, sitting in a modern, clean office or studio setting. A chart with financial data is visible on the screen behind you, but it's slightly out of focus. Hello, everyone, and welcome back to the channel. Today, we're diving into one of the most critical, yet often overlooked, aspects of successful trading: mastering your emotions. We've all been there, right? You see a trade going against you, and that little voice in your head starts whispering, "It'll come back. Just hold on a little longer." Before you know it, a small, manageable loss has snowballed into a catastrophic one that wipes out weeks of profit. Sound familiar? This emotional roller coaster, fueled by fear and hope, is the number one reason why many traders fail. The market doesn't care about our feelings. It doesn't know you need this trade to work out. It's a relentless machine of supply and demand. So, how do we protect ourselves from our own worst enemy, our emotional brain? The answer is simpler and more powerful than you might think: the strict, non-negotiable stop loss. Now, I know what some of you are thinking. A stop loss? That's trading 101? Yes, it is. But are you truly using it correctly? A stop loss isn't just a technical tool. It's your primary psychological shield. It's the pre-commitment you make to yourself, with a clear and rational mind, before the emotional chaos of a live trade begins. It's your escape plan, decided upon before the fire even starts. Let's break this down. When you enter a trade, you should have a clear thesis. For example, I'm buying this stock at $100 because it has broken above a key resistance level, and I believe it will go to $120. But what if you're wrong? What if the breakout was false? Your trading plan must account for being wrong. That's where the stop loss comes in. It's you saying, if this stock drops to $98, my original thesis is proven invalid, and I will exit the trade to protect my capital. The key word here is asterisk, strict asterisk. A mental stop loss is not a stop loss, it's a wish. It's an open invitation for your emotions to take over. When the price hits your mental stop, you'll hesitate. You'll start to rationalize. Maybe I'll give it a little more room. It's just a quick dip. It will bounce back. This is called cognitive dissonance. Your brain is trying to avoid the pain of admitting you made a mistake. By the time you finally give in and sell, the loss is often 2 or 3 times larger than you originally planned. By placing a hard stop-loss order in the system the moment you enter a trade, you are automating your discipline. You are outsourcing the decision to exit to your past, more rational self. Think of it as a contract you sign with yourself. You are legally, or in this case, technologically, bound to honor the terms you set when you were thinking clearly and objectively. Let's talk about the two biggest emotional culprits: fear and hope. When a trade is profitable, fear kicks in, fear of giving back profits. This often causes us to sell too early, cutting our winners short. But when a trade is losing, a different, more dangerous emotion takes over: hope. We hope it will turn around. We average down, we move our stop loss further away, we pray for a miracle. Hope is a beautiful human emotion, but in the context of a losing trade, it is financial poison. A strict stop loss brutally, but necessarily, eliminates destructive hope from the equation. It forces you to confront the reality of the situation and accept a small, planned loss. This is the very essence of risk management. Professional traders don't focus on how much they can win on a single trade. They are obsessed with how much they stand to lose. Their first question is always, where is my exit if I'm wrong? They know that preserving capital is the name of the game. You can't play if you run out of chips. A stop loss is your capital preservation tool. It ensures that no single trade can ever knock you out of the game. It guarantees your survival to trade another day. So, how do you set a proper stop loss? It shouldn't be arbitrary, like a random 2% rule. Your stop loss must be based on your technical analysis. It should be placed at a logical level where your trade idea is invalidated. This could be below a key support level, under a recent swing low, or on the other side of a moving average that you respect. The placement of your stop tells you that the market structure has changed, and the reason you entered the trade is no longer valid. This turns exiting a trade from an emotional failure into a logical, unemotional execution of your plan. You're not losing, you're simply managing risk according to your strategy. This mindset shift is profound. A triggered stop loss is not a failure. It is a success. It is your system working perfectly. It's your discipline shining through. It's your plan protecting you from your emotional self. You should feel good when a stop loss is hit, because it means you followed your rules. The real failure is not taking the small loss. The real failure is letting a small loss become a big one because you are too proud or too hopeful to stick to your plan. I want you to try an exercise. For the next 20 trades, commit to this rule. You are not allowed to enter a trade without immediately placing a hard stop-loss order, and under no circumstances are you allowed to move that stop-loss further away from your entry price. You can move it up to lock in profits, but you can never give the trade more room to breathe. Document how you feel. At first, it will be hard. Your ego will fight it. But after a while, you will feel a sense of liberation. You'll no longer be staring at the screen, white-knuckled, praying for a reversal. You'll know that your maximum risk is defined. You've accepted it. You can walk away from the screen, confident that your plan is in place. This process transforms you from a gambler into a business owner. A casino owner doesn't worry about one gambler hitting a jackpot. They know that over thousands of hands, the statistical edge will play out in their favor. Your stop loss is your edge. It ensures that your losses are small and contained, while your winners are allowed to run. This is how you create a positive expectancy over the long run. By strictly implementing stop-loss orders, you are finally taking control of the one thing you can actually control in the market, your risk. You are removing emotional decision-making and replacing it with systematic, disciplined execution. And that, my friends, is the true secret to longevity and success in this business. Thank you so much for watching. This is a topic I am incredibly passionate about because it's what separates the pros from the amateurs. If you found this video helpful, please hit that like button, and if you haven't already, subscribe to the channel and turn on notifications so you don't miss our future content. Let me know in the comments below what your biggest struggle with trading psychology is. I read all of them. Until next time, trade smart and manage your risk.